Right, hello everyone. Thanks for joining me. Thanks for joining me on today's webinar, how to get out of and stay out of debt. Obviously, this is Crush Your Debt Week with Salary Finance, and we're really focused on helping people get out of debt and into savings. If we've got time, I will answer any debt or money related questions, so put those in the question box and I'll try and get to as many as I can. If I don't get a chance to answer your question or get to any other questions, then we will do written answers after the event and post those to the Salary Finance Learn website. And that is the Salary Finance Learn website where we have all our financial information. Well, let's get cracking then. So this is all about how to get out and stay out of debt, a subject close to my heart, as you'll find out in a minute. So my name is Jason Butler, and I'm the head of financial education here at Salary Finance. And if you're not aware, Salary Finance is an employee benefit that's available to you, and we're on a mission to get people out of debt into savings. And we offer products including affordable loans, which will repay through your salary, the ability to access earned salary before pay, as well as the ability to save money directly from your wages. What your employer offers may well differ from all of those products and services, but what you all have access to is the financial education resources we provide via the Salary Finance Learn website, which has got videos, it's got blogs, it's got articles, it's got tools. And one of my jobs is to bring that stuff alive and help you make better decisions. It's not to tell you what to do, it's just to share insights and give you that motivation and give you some of the insights that will help you win with money. Now, I just want to make it clear that at the beginning, this webinar is aimed at people who've non-mortgage debt, like credit cards, store cards, overdrafts, and term loans, which they're keen to get rid of. But for whatever reason, they've not been able to. And it's not aimed at people who are suffering severe financial distress, such as facing legal action or having difficulties meeting essential expenditures like rent, mortgage, or other core living costs. If that sounds like you, or you know someone who it does sound like, please contact your local Citizens Advice Bureau and ask to see one of their free money advisors for personal guidance. There's another charity called Step Change, which is also excellent, and they provide help for people in financial distress. Now, a few thousand years ago, there were Stoic philosophers. They basically had an approach to life where they said there are only two things that we can control in our lives. One is our attitude and how we react to things, and the other is our actions, what we actually do. Everything else is outside our control. So whether it's the economy, tax rates, as we've just found, there's going to be an increase in tax, oh, big surprise, inflation, the success of your employer, whatever it is, you can't control that. But what you can control is how you think and what you do when it comes to money in general and debt in particular. Now, look, unless we build a savings reserve that we can call on, there's always going to be things that we legitimately need, which aren't luxuries, but that we can't afford from our own resources. Now, a good example is when you're renting your home and you want to move, or the landlord's asked you to move and you need a deposit for your new property. But you can't get the property deposit back from the previous property until you've moved out. So you're in this catch-22 position, and that happens to quite a lot of young people, young families, or people who've had changes in their personal circumstances. And so therefore, if you haven't got savings and you still need to come up with a deposit, what do? Where do you get the money from? That's when you can fall into expensive debt. And if a car is essential for you to get to work because there isn't adequate public transport, or you live in a rural area, then occasional repairs that you weren't anticipating can come up and really put a spanner in the works. A bill for £300 or £400 can throw you off track. I know, I've experienced it. I remember when we moved into our house 23 years ago, it was really tight on the finances and the boiler went wrong. Now we had to pay, I think it was nearly £500 to patch it up. And eventually had to replace it with, that cost even more, it was about £3,500. And then there's personal care. I mean, I don't know about you, but I have over the years had dental treatment, which I wasn't expecting to pay for. You know, a filling drops out, you need a crown done, something happens. And that can run to hundreds, if not thousands of pounds. And if you haven't got the money for it, you can slip into debt. Now, I want to just kick off with our first poll. Let me make sure everyone can hear this. Just want to check my colleague that everything's fine. Yes. Okay, I'm going to kick off the poll. I want to know, in the past 12 months, have you had an unexpected expense that you couldn't meet from savings? So that's just kick this poll off. I'm going to launch that. So basically, it's either over 1,000, it's between 500 and 1,000, it's less than 500, or no, you had it all covered with savings. So vote away. And that should be delivering now. So please vote away. Want to know if you in the market, it's actually the last 12 months, not the last month, the last 12 months, have you had an unexpected expense that you couldn't meet from savings? Okay, let's close that poll. 3, 2, 1. Going to close the poll now. Okay, share the results. Okay, so look, here's the thing. All right, 1/3 of you have covered it with savings, great. But that means that the vast majority of people have had something whether it's under 500, but it seems to me that, the vast majority of people have had something come in that they weren't anticipating coming in. So it happens with everyone, right? And even the best laid plans can cause you issues, all right? So let's just crack on. Good. So now, what you got to remember is if we are going to borrow for those legitimate things, obviously it's going to cost us interest, and that interest can cost us a lot more than we realise. And interest is really a penalty that you pay for the right to own, use, or experience something in advance that you can't afford for your own resources now. And that becomes more of an issue if we buy non-essential items or luxuries or things that we don't need. And if you use debt to fund that, then what you're really saying is that you want those things so bad that you're prepared to pay more for them in the form of interest. Now, a classic one is buying a more expensive car than you really need or can afford, right? I've seen this over the years. And then there are holidays. I know we all need a break from routine and to recharge our batteries, but going on an expensive holiday is not essential, particularly if you're keen to get out of debt and build savings. And jewelry, fashion items, smartphones, they all eat your money. So unless you've got ahead financially, but then you've got to be really careful and intentional with your spending. Now, we live in an age where it's easy to get into debt, right? And the average UK adult has about £3,700 of unsecured debt. So that's credit cards, overdrafts, loans, etc. And the average UK household has around about £2,000 of credit card debt. And that's June figures from the Money charity. And in fact, this article from the Guardian a couple of years back said that the average UK household debt, this is across every household, was 15,400. And of course, that masks some people who've got very, very high levels of debt and some who've got none. And I think really what's happened, the way that debt has creeped up on us is not only are we living in expensive times, but it's come about, I think, because people think debt is normal and they use it to fund consumption. But here's the thing, I don't want you to be normal, I want you to be abnormal. Now, that doesn't mean to say I want you to feel shame or guilt about having debt, but it comes from thinking differently about debt. So let's now talk about the cost of debt. Now, obviously, if you borrow money from family and friends and they don't charge you interest, that's going to be the cheapest form. But credit cards, store cards, and overdrafts, they're a form of what we call revolving credit. And that means that there's no plan to repay them. And if you just pay the minimums, obviously it's going to take you forever to pay them off. And there's no structured way of actually getting rid of them. And that's really why the banks and credit card companies are keen to push those products, because they want you to keep that borrowing for as long as possible. But as we're going to see in a minute, having a structured repayment plan on our own fair interest terms can help you really hammer that debt. And that's what salary finance came into business for. The story was all about Asesh, who was the founder. His nanny was she accumulated debt, and he said, well, let me pay it off, charge you a very modest amount of interest, and I'll deduct it from your wages. And that's what salary finance did. It made it impossible to miss payments. It made sure that there was no distribution costs because it's done through the employer situation, so the interest can be a lot lower, and it helps people build good habits. So the key to being financially well is getting and staying out of debt, and you've got to break the burden of debt, and that starts and ends with how you think about spending and what's important. Now, look, I've got some bad news and I've got some good news. The bad news is this is going to involve some short-term pain, and it's going to involve a little bit of focus and effort, but the good news is that pain's worth the effort. And I know because I've done it. And I grew up in a very poor household. My mum was a single parent. She had 4 children. She was in debt her whole life. And she only passed away this year. And she still had no money when she died. And she literally struggled from week to week. And I know what it's like to be really up against it, because I continued those money habits that my mother taught me, even subconsciously, into my early 20s. And I was a complete and utter train wreck. And I was out of control on spending, credit cards, overdrafts, you name it, I had it. And I had an epiphany I was about 24, 25, and I decided that things had to change. And that's why I'm so passionate about this, because I know the difference it made in my own life. Now, look, none of us are perfect. We all make mistakes, and we can't choose our upbringing, right? But we can only start from where we are now. The past is the past, we can move forward. And I want you also to have that epiphany that you're going to change your relationship with money and finally get debt free, okay? Now, think of you and debt like a relationship that's had its day. We've all been there, haven't we? You know, you're going to tell your debt that it's just not working out between the two of you. That essentially that you're not right for each other. It's over, you're moving on. You've got to get really serious about becoming debt-free. You've got to get absolutely clear that this is not going to continue. You're going to make that decision like I did in my mid-20s, and you can and you'll be better, and you're going to get debt-free. Remember, it's progress, not perfection. But you've got to do whatever's necessary, and it can be done. There are lots of real-life stories of people who had many thousands of pounds of credit cards and overdrafts, and they became debt-free, so it can be done. And you don't need to rob a bank or win the lottery. In fact, obviously, you've got more chance of dying than you have winning any prize in the lottery between buying the ticket and the prize draw happening. But here's the thing, I don't also want you to feel shame or guilt or that you've somehow got a character flaw or you're stupid. Absolutely not, because this is a behavior issue and it's about designing better behaviors and being much more intentional about how things happen to you. So I want you to imagine your life without debt. How will you think when you've achieved that? So let's have another little poll, because if we can get connected with the emotions of being debt-free, there's more chance that we're going to find our way through it. So I'm going to launch the poll now, and I want you to tell me, what would having no non-mortgage debt, would it improve your quality of life? Yes, it would reduce my money, stress and worry. Yes, it would allow me to do other things with my money. Yes, but the change wouldn't be big. Or no, I don't have debt, or I don't worry about the debt I have. So please vote away. Now, be honest with this. I want to know how you're going to feel. This is all about what's the benefit of being debt-free as opposed to using debt to buy things. So there we go. Let's have a look. I'm just going to close that off in 3, 2, 1. Okay, let's share the results. Fascinating, absolutely fascinating. Yes, a third of you, it's going to make a big change to your life and reduce money worries and stress. And the vast majority, nearly 60%, yes, it would allow you to do other things with your money. That is brilliant, right? And we've got no one who says, I don't have debt, I don't worry about the debt. So that's great. Look, here's the thing. Think about that as the benefit. That is the benefit. That is what's going to help you get going. Okay, it's not going to sustain you because that doesn't work. Motivation is a fickle friend. Now, look, I want to talk about how this is not about judgments. Forget the past. We're going to learn new behaviors, and I'm going to help you with a couple of strategies that are going to help you get ahead, right? And if some of these you already know, great. If some of them are new, great. Share them with other people as well. So what you often do is you might think that your spending is in a straight line. You know, my spending is whatever it is a month, right? But really what's happening is your spending is varying from month to month. Now we know that intuitively, but we don't actually acknowledge it, most of us, formally. We know it does vary, but we kid ourselves our expenses are $1,000, 1,500, 2,000, 3,000, whatever your number is, whatever your household situation is. Now, obviously, there are core essential expenses, and I'll show you those in a minute. But what's happening is it's changing from month to month, and it comes in different ways. And if you've got lots of different expenditures coming in that you hadn't anticipated, and they're beyond what you've got coming in, then you're going to build up this mess on the top of this seesaw here, which is lots of small overspendings, which leads to a tipping point. And that's what leads you to go into debt. So it's not always big expenditure, although it can be, but it's lots of little, there's death by 1,000 cuts. And remember this, a very famous saying, it's easy to wander into debt, but it is not so easy to wander out. So look, you might start off with an overdraft, and then it's a credit card, and then it's a store card, and then it's a loan. And before you know it, you've got several payments going out on debt, and that's laying claim to your income every month. So you've got to break that cycle of what got you into debt in the first place. So forget the past is done, you can't do anything about it. This is a new clean sheet. And this is a good time to think about it, right? So let's take this example. Now your numbers are going to be different. Let's just say, work out your own numbers in your own categories. But someone thinks they're spending £2,000 a month, right? And in this scenario, that's what they think is going up. But actually, when we add on all the other expenses, the ad hoc expenses, the Christmas, the clothes, the car servicing, the vet bills, the holiday, all that stuff, you know, I don't know about you, I've got 2 dogs, and every time I take them into the vet, something happens. They need their teeth cleaned, or they need a booster jab or something, and it seems to be like means tested. So basically, in this situation, this person's ad hoc spending, which is coming along pretty regularly, but not every month, is adding another £600 a month. So what they need to do is they need to allocate and put that money aside for those expenses which they're not quite sure where and when and exactly how much they're going to be, but we make an allowance for it. We make an allowance for the true costs, and that's called embracing all our expenses. And because, as I say, it's inevitable, it's going to happen, right? We know Christmas comes every year. We know we're going to go on a holiday. We know the car needs servicing and MOTing. So there we go. That's what we've got to do. We've got to get the true monthly allowance, including the ad hoc. So embrace everything, get it all down, be clear about where it's all going, and make an allowance. And I mean everything. I've got a National Trust subscription. That goes in. I have a window cleaner comes around every 2 months for 35 quid. That goes in at 17 quid a month. I know it sounds petty, but once you get into this habit, and it's a habit, it's a behavior of allocating for everything, and I mean everything, you start to get more control. It doesn't mean crap doesn't happen. It doesn't mean you don't get disappointments and stumbles, but you start to get on the front foot. Okay, now another thing you can do is approach what we call the CEO approach, which means looking to cut costs where you can cut them, trying to earn more money or turn existing assets or unused stuff into cash, and optimize what you do have to spend. You know, are you on the lowest mortgage? Are you on the lowest insurance? And that's why salary finance is in. If you've got debts that are costing you 15, 20%, 25%, you could halve that possibly, or a third it, or reduce it by a third. You know, but the point is optimizing what you're already having to spend is like a pay rise. So cut costs, earn more, optimize what you have to spend. Now, another tool that can help you, as I say, just going back to the optimizing, I mean, I don't know about you, subscriptions on phones, go through those, stuff you signed up for direct debit, trials that you're on. There's so much wastage that people can cut. I've never met anyone where if I looked at their situation, I couldn't find savings. And here's the thing, even if it's a small saving, it doesn't matter. It's that principle of you being intentional. Don't beat yourself up, but just do not let your money leak. Now, when we think about spending, this is the system. It's called the Smart Spending System. And I developed this many years ago, or a version of this. And this is how it works. It's just, there are 3 routes that your money's going to. It's the essential you to fund all your living costs now. There's the fun you, the bit I like, it makes life interesting, the stuff you don't really need to have, but it's great to have. And there's the future you, which is building savings, investments, and paying off non-mortgage debt. So the way it works is that you have 4 different accounts. Your money's coming into your current account, and then you park some money over into an emergency fund. That's not smoothing, that's not to meet ad hoc expenses, that's just for unforeseen emergencies. So an emergency would be my tooth crown broke and I needed to spend a couple of hundred quid doing it. But ongoing spending, you know, normal essential spending would be going to the dentist and having my normal clean once a year. That might be 20, 30 quid. So you see the difference. Then you have a spending account. That's what you park your money into to meet all the fun stuff. And then you have a smoothing account. And the smoothing account is where you put money in to meet whether it's future expenses or whether it's essential expenses or whether it's fun expenses, but that are not going to be incurred this month. If you use this system or a version of it or find your own system, it will help you because it's about partitioning and it's about knowing where the money's going from. And it's okay to put your hands on emergency fund money if you're going to need that because an emergency happens. That's the beauty of this. You can download a graphic of this from the Salary Finance Learn website, and that will help you. So there we go. Take a screenshot, do whatever you want. You will get a recording of this, and it will be on an unlisted YouTube video. So you'll be able to look at this again. But that can help you. It really changed my life. So there we go. Now let's talk about, this is a website called whatsthecost.com. Now it's an interesting thing because what it enables you to do is it enables you to work out what things are costing you and how you could actually get rid of your debt and the cost of either the benefits of overpaying or the benefits of getting a lower interest rate. So this person here in this example is just over £2,600 on a credit card. The interest rate is 18.67% and the minimum repayment is 2%. So what have we got here? Let's just have a look. Okay, so it would take 590 months. That's 49 years to pay back 2,600 quid if you only pay 2%, right? And so that means you're going to pay £7,900. You're going to pay 3 times more than you borrowed, 4 times more. I mean, it's unbelievable. So let's move forward on the next situation. So let's now look at the scenario. Okay, but it would only take you 25 months to pay back 2,638 if you pay the required minimum of 2% plus an additional £100 a month, right? So over that time, you only pay £464. So still the same interest, but you're just overpaying, right? Now, what about if we were to take that loan, that credit card debt, and put it on a loan that pays 9.9% APR, which is a typical salary finance loan, and we only pay the minimum, then it's still going to take us, 23, oh, well, here we go. So we're still going to pay the £100 overpayment. So we're hovering the interest rate almost. We're still paying that £100. We pay it in 23 months. So here's the thing, the interest rate does make a difference, but what really makes a difference is the amount you pay off of the debt. So it's really important not to pay minimums if you can avoid it. Another thing, we've all got gear we can sell and turn into cash, right? All of us. My daughter has just sold a pair of trainers that she paid £65 for. She's just got 50 quid for them. They were 3.5 months old and she had worn them. And she disclosed this to the purchaser. They're very happy. There's people want your gear. So car boot, eBay, whatever it is, put stuff outside your house, you'd be amazed what people will pay. Never give anything away that you could potentially sell. Okay, now let's talk about how you might be able to pay off debt very quickly, okay? So the hard way is that you just got a rumble jumble of different loans and agreements, and you're trying to pay these all at different dates and different times, and you're all over the place. Now, logically, you should be paying off the interest, the most off of the loan that has the highest interest rate, okay? But logic doesn't work, does it? Because if it was logic, we wouldn't have the debt in the first place. So what we've got to do is we've got to use a system that works psychologically, that helps us stay the course. Doesn't just, after today's webinar, you're all excited. It's got to be something you're going to stay with. And the studies show that a system called the snowball debt repayment method is the single most effective means of paying off persistent non-mortgage debt. And this is how it works. You line up all your debts, smallest debt to largest debt. You put minimums, or the minimum you can possibly pay on everything except for the smallest debt. You try and find as much as you can that's sustainable, that's not going to be your own, rice and crackers, that you can basically come up with, and put as much as you can into paying off the smallest debt. Then, once you pay that debt off, you divert that money that you were paying into that smallest debt, that one, into the next smallest debt. And the next debt, so you're still paying, in this case, £250 a month, but gradually more and more is going into paying off all of the debts until you end up with no debt, and you still got the 250, which you've got used to paying. You can then open a salary finance savings product, right, which is deducted from salary, or a savings account with someone else and do a direct debit or a standing order. And that's how you build savings. So we're going from debt to savings, and this stuff works. It really psychologically, what it does, it helps you feel like you're making progress, even if you've not finished the journey. And that's why it really, really works. Now, here's the interesting thing. We're seeing salary finance customers are coming to the end of their salary deducted loan. They're deciding to continue having that deducted from their salary, but they're now having it put into a savings account because they know that they can afford the amount, and they've broken the association with debt, and they're now building savings. And I interview these people. I do interviews with them, and it's a joy to behold when they tell me this story. One guy recently, he said, I feel now taller. I feel lighter. I feel more in control. Doesn't mean he doesn't have, little setbacks and little, problems with his situation, but he's making progress. So there we go. That's what I would suggest you have a look at there. Now, one thing just worth saying here, if you have very large debt as part of your snowball, you might want to look at if salary finance can reduce the cost of that as part of your debt snowball. If it's going to be a debt that's going to take you a while to get rid of, the farthest away, and it's expensive as well, it might be worth just replacing it with a salary deducted loan for the same sort of monthly payment, because it will enable you to put more money to those other debts to get rid of them quicker. And of course, there's no penalty to paying off a salary finance loan earlier if you can. Now, it's worth saying, if you've ever done anything, you've tried to change things, what you eat, exercise, anything that requires a bit of effort and changing habits and routines, it's easier to do that with someone else. And I call it an accountability partner. So my recommendation is this, that with money, there's still a big taboo, right? We all think everyone else has got this figured out, and somehow, we're going to be judged. Well, find someone, a friend, a partner, your partner in life, a colleague, whatever it is, who can go along on this journey with you, and either can hold you to account, or you can share this journey together. They might have a bigger debt than you, or they might be having different situations to you, but find someone who you can link in with and sort of encourage each other. And another thing you can do is think about having a mentor or a role model. So this is not comparing yourself to someone else. This is saying, I found someone that I trust or I respect, or I'd like to be like, and I think I could get there. They're 3 or 4 steps ahead of me. There's a great lady called Maria Nedova who wrote a book called Never Bet on Red, and she paid off £100,000 of non-mortgage debt in 3.5 years, and she was on a webinar with us. It could be her, it could be someone else, it doesn't have to be someone you know, but just have to be someone you think, I could get to where they want to go. There are loads and loads of resources about how you can be good with money on the Salary Finance Learn website. There's also a video series where I teach you all the basics and also the intermediate stuff. There are videos, as I say, on there. There are tools, there are blogs, there are articles. You can sign up for a newsletter and we'll keep you informed of what's going on. So there we go. As I say, if you can just take those stages forward, then I think it will help you. So there we go. There's no magic to this. I don't want to make a big deal about the sacrifice because it isn't all pain. It's also about you basically developing a new set of habits. And if you're having trouble with this, it's not normally you are the problem. It's the environment or how you've set things up. It's basically how you are allowing yourself to use money. If you're having trouble holding on to your spending and controlling your spending, perhaps stop using contactless payment, right? I'm not saying it's ideal using cash, but perhaps stop using that. Or again, use a separate account like the smart spending system. So there we go. So let's just have a look then. I want to see, let's have a quick final poll here. I want to know what you are going to do after today, because there's no point in me going off about this. What first action are you going to take to improve your debt-free journey, to take you to the next level? So I'm going to launch the poll. What first action will you take on your debt-free journey? Review all your existing debts, balances, interest rates. See if Salary Finance or Neighbour, if your employer uses them, can replace some or all of your existing debt. Use the debt snowball method. Sell off unwanted stuff to reduce your debts, or adopt the smart spending system. It could be all of them, but just choose one of them. I want to see what you're going to do. It doesn't matter. I want you to take control of this. And remember, another thing, I want you to think small. Just take one small job. If you think reviewing your existing debts is too painful, then why don't you just look at some selling off stuff for 100 quid, see if you can get £100 worth of stuff sold off and use that to reduce your debt. If you don't like the idea of actually doing anything other than just learning more, then why don't you review the smart spending system? So I'm just going to close that poll now in 3, 2, 1. I'm going to share those results. Right, so the vast majority are going to review all your existing debts. The next one, the most popular, is adopt the smart spending system. Well done. See if Salary Finance can replace some or all of your debts. Use the debt snowball. It doesn't matter what it is. I'm really, really proud of you. Really, really proud that you're going to do this, and it's really what it's all about. So look, I don't know if there's any. I don't know if there's any debts here. Any questions here? Just going to quickly look. Oh, Yasmin is saying you can pay minimum on an interest rate, 0% interest rate, and then you're only paying what you originally spent. Here's the thing, Yasmin. You're not being clever because you've got a 0% interest, right? You still owe the money, and at some stage you're going to have to pay that money back. So I would turn it around and say you're not clever by not paying back, just paying the minimum. You want to get rid of that little puppy because you owe someone the money. Once the money has been repaid, you then can reclaim your control of your spending, and that's the way you get ahead. I don't know anyone who's successful financially who juggles 0% credit cards. Look, if there was a special thing here, banks would not be offering these 0% deals. They wouldn't be offering them. They aren't a charity. They're doing it because it's a business development tool. It enables them to ensnare people into unstructured borrowing. That is why they do it. There is no special deal there. So anyone, unless there are any other questions there, I'm going to say thank you very much for joining me today. There will be a recording of this. Look, here's the thing. If you are having some successes or you're finding you've got some obstacles and you want some help, please do get in touch with us at question@salaryfinance.com. Very, very pleased to hear from people. We want to hear about your successes, but also if you've got some challenges. And if you want us to do other webinars or other type of educational support, please let me know. Always love to hear from our community of customers, because at the end of the day, going from once you've got out of debt, your next stage is to build savings. Once you build savings, you can then have more control over your life. So unless there are any other questions, it's just for me to say thank you very much for joining me today. It's been a pleasure, as always, hanging out with you guys. And I hope to see you at next month's webinar, where we're going to be talking about a host of issues like mindset and psychology and how you can make more progress with your money. So thank you for joining me. Good luck, everyone.